New York City. The street is quiet. Christmas lights glint on the empty street. Wall Street believes in Santa. Not the red suit, not reindeer, but something much stranger. Because for decades, some of the strongest stock market advances in U.S. history have occurred around Christmas time. No announcement, organized firework, just money appearing out of the blue. Shareholders always have the same question every year. Is this real? Or is this all simply the story that Wall Street likes to tell itself? This phenomenon is known as Santa Rally. And before you roll your eyes in annoyance, here comes the part of the message that most people do not expect. It appears in the actual data, again and again. Since the 1950s, the S&P 500 has tended to go up more often than down during the final 5 days of December and the first 2 days of the new year, about 3 out of 4 years. That's not folklore, that's math. And here's why that affects us today. December marks the end of the year. It is the emotional peak of the American economy. Bonuses are paid, retail sales peak, tax decisions get rushed. These emotions drive markets in the short run. Let's say you are managing a $1 billion investment fund. It is December 20th. Your performance is public. Whether you like it, your competitors are watching. The clients are judging. Do you have daring risks at present? Or do you buy what everyone knows is safe in the back room while quietly looking smart in January? That instinct, the desire to protect reputation, is one of the invisible drivers of the Santa Rally. Large funds rebalance. They clean up portfolios. They transfer funds to large known United States firms, Apple, Nvidia, index funds. Not because they're magical, because nobody gets fired for owning them. This is where psychology comes into play. The human brain has a liking for clean endings. New year, new beginnings, new optimism. So investors look forward to hope before it exists, and Wall Street prices that hope in advance. However, the Santa Rally certainly did not begin through CNBC buzz on Twitter. It began quietly. A market analyst named Yale Hirsch pointed out an irregularity in the market in the year 1972. The stocks continued rising during Christmas. Not every year, not so often, however, to be statistically significant. He published it. Wall Street took notice. And once traders realized, the behavior began to reinforce itself. That's the difficult part, because when enough people believe in a pattern, they start trading in that pattern, and trading it away makes it real. But here's what never makes the holiday headlines. Sometimes Santa isn't there. In years like 2000, 2008, and 2018, the rally proved unsuccessful. Easy. Because in the end, nothing withstands fear. When liquidity squeezes, when bad news surrounds optimism, Christmas doesn't matter. This, of course, is the point where individual investors don't understand. They look at Santa Rally and see guarantee. They're looking at their charts and seeing all those green columns but the market won't reward faith. A market that rewards timing, liquidity, and behavior. The volume of trading in December is down. Fewer people at desks, less resistance to price movements. Thus, even the slightest purchasing pressure can cause prices to rise. It's not strength, it is thin air. But thin air is wonderful until it isn't. Now, zoom out. Why is this phenomenon more prevalent in the U.S. market in particular? Since it is America's market that is the world's risk engine. Global funds also invest their funds at the end of the year in our American stock market indices. American stock market indices are standards. The dollar is still king. That is why the antenna. Therefore, when uncertainty increases in the world, money doesn't go home for Christmas. It comes to Wall Street. This can fuel markets, temporarily of course, with no change in fundamentals whatsoever, which gives way to the final conflict. What takes place when the lights go down? January is where optimism and reality intersect. New guidance, new earnings expectations, new selling pressure. Some of the worst corrections historically come after strong Santa rallies. Not always, but often enough to matter. So here's the real question. The Santa rally, is it a present or a test? A sign of confidence or a reminder that markets are more driven by emotion than by logic? Because every year in December, Wall Street smiles, markets become less liquid, hope it revives, and investors secretly place their bet.